So yes, hello everyone. So this will be our first discussion for our subject. And yes, the first part is understanding the contents of financial reports. So to proceed, so we'll have first the statement of financial position or the balance sheet. So our statement of financial position consists of our assets, liabilities, and equity, in which our assets equals liabilities plus equity. So that's our balance sheet now to review. So uh, as in our module, so you have there in our assets, we have in the investing activities. So we do that into our assets, which consists of our short-term investments and long-term investments. So when we do investing activities, that affects our short-term investments and long-term investments. But as to the liabilities and equity, we do the financing activities in which we use the short-term debt, and the owner's equity is affected since we are also using, no, or we are using the owner's equity, the shares. No, we buy, we sell shares of stocks. So that is why financing activities affects our liabilities and equity. And the other one is the no, I forgot. Yes, the operating activities, which affects, no, all of our items in our balance sheet. To go back. So that's it. So we have investing activities, which affects our assets, the financing activities, which affects our liabilities and equity, and the operating activities. No? Next is we have the statement of comprehensive income. So our OCI, no, the statement of comprehensive income is also our income statement, which consists of our income less expenses, and that would equal to our profit. So the statement of comprehensive income is affected by the working capital of the enterprise. So what is this working capital? So net working capital, it is the equity participation of the enterprise in managing and completing its normal operating activities. So our net working capital would be current assets less our current liabilities. So in the normal course of business, we use our current assets, and we are also using current liabilities. So uh, in the normal course of business, we use our cash. No, that's our current one of the examples of our current assets, cash. The inventories. No, if we are in the merchandising business, we do have inventories. Of course, we buy and sell, so that's very important. Marketable securities. What else? Accounts receivable. No, the items that are considered our current assets, we usually use that, no, in our normal course of doing our business. So if we use those current assets, we are also using our current liabilities. So we are incurring short-term obligations, no, to have our current assets. We usually purchase merchandises on account, so that's accounts payable, and that merchandise that we have purchased on credit, so ginutang naton, will form part of our current assets. So that's uh, the current assets less current liabilities, and that's the net working capital. So the important note that we are going to take is net working capital must be positive. Why? Uh, our current liabilities must not exceed our current assets, since if that's the case, that means that our business is not doing good. No, we incur more of our liabilities than having our current assets. So that would impose that the business is not doing good. So we should have a positive net working capital. So that is why it says here that the statement of comprehensive income is affected by the working capital of the enterprise. So if you have a negative net working capital, so your statement of comprehensive income is affected. So that means you are incurring losses na, no? Since you are not using efficiently uh, your assets, no? Kay nagautang kita damo, but we don't have cash, no? And we don't sell that much since our accounts receivable are less, no? Wala kita nagabaligya efficiently na if we are in the merchandising business. So that's the net working capital or working capital. It's still the same, no? In for purposes of our discussion, working capital and the net working capital is the same. Then let's go to the financing side and the financial leverage. No, this is on the financing side. So we are on the liabilities and the equity side of the balance sheet. So financing refers to the process of raising money from owners and creditors to sustain the wealth generating activities of the enterprise. So in the balance sheet, uh, our assets is actually um, financed by the owners, and that will form part of our equity, and also it is financed by the outside or by the outsiders, those who are creditors, no, the yes financiers, venture capitalists, no, investors. So those are those who finance, those outsiders who finance our assets will form part of our liability, no? So our assets are financed first by the owners, which will form part of our equity, and the outsiders, which consist of our creditors, investors, and all, in which kung ano ang ilang finance sa aton will form part of the liability side of our balance sheet. So, muna siya, financing. Financing from the owners, again, to that will form part of our equity, and financing from the creditors, that in which it will form part of our liabilities. Then, that is to sustain the wealth generating activities of the enterprise. So, we do have two financiers, no, to continue our business. So financing precedes the investment activities. Of course, we cannot invest if we don't have financing, no? Diin kita makuha kwarta, of course, from the owners, no? Or even mahulam kita from our creditors so that we can invest. So we have here the illustration. So let's disregard first the asset side, which investing activity, since we are uh, discussing the financing activities. So we have liabilities, which consist of our short-term and long-term liabilities. Short-term liabilities are those that we are paying within 1 year, no? And for long-term, in which we are going to settle those liabilities for more than 1 year. So that's the difference. Then we have here the financing ratios. So financing ratios, first we have the debt ratio. The debt ratio, the formula could be the total debt divided by the total equity, or the total debt divided by the total assets. It's still the same. Now, the total equity is kung sa aton pa is on the right side of the accounts, no? Since asset is on the left, then the liabilities and shareholders equity is on the right. So liabilities plus shareholders equity is equal to equity, no? And it's still the same with the total assets, no? So in order to not complicate things, total debt divided by the total assets, that would be the debt ratio. So kung debt ratio, as simply it's the ratio of all the liabilities, no? Diba, the total assets consist of those that being financed by the owners and those that being financed by the creditors. So ang aton ginakuha is the ratio of on which ang gin-finance sang creditors lang, no? Our total assets. So that is why we have the total debt divided by the total assets. So pila ang percentage ni creditors from our total assets. So that's the debt ratio. So we have also 1 minus equity ratio, no? For purposes, of course, for discussion, if there are problems that equity ratio lang ang ginapangita and you don't have the figures for your total liabilities, no, equity ratio lang. So, no, to manipulate the formula. So, you have 1 minus equity ratio. So, equity ratio is ratio naman niya sa finance ni owners, no? So, of course, kung makuha mo na, so ang bilin is the ratio ng finance ni creditors. Okay? Or the EM minus 1. So, EM is the equity multiplier minus 1 divided by the equity multiplier. So, that's more complicated. So, we'll discuss that with further for the next presentation. So, I have a example, no? But this is just to present first the formulas, no? Then equity ratio, so we're done with debt ratio. Equity ratio, of course, 1 less the debt ratio. Equity ratio is ang ratio ni shareholders, no, from our assets. So that is why 1 less debt ratio. So we get the equity ratio, of course, the residual. Then 1 minus equity multiplier. Equity multiplier, let's discuss that in our example so para maintindihan ta siya. Debt to equity ratio, so the ratio of our debt to our shareholders equity. So debt to equity, so ratio ni liabilities to the whole equity. Now, this is the shareholders equity, this is the liabilities. So liabilities plus shareholders equity must equal to our total assets. So it's still the same. Debt to equity ratio ni liabilities to the total no, liabilities to the shareholders equity, not to correct. So debt to equity. So ano ang percentage ni debt kay shareholders equity sa ila lang ya duwa, but not to the total assets. Okay, that would be debt ratio na. Okay, so again, to review, I must be complicating no things. Debt ratio, that's the ratio of our total liabilities to our total assets, to simplify. Debt to equity ratio is the ratio of our debt in relation to our shareholders equity only. No, sa ila lang ya duwa, ara sila ya sa dalo. So, we'll understand that further with our example. Then we have here equity multiplier. That would be our total equity, or that would equivalent to our total assets. Now, total equity is the total assets divided by the shareholders equity. So, shareholders equity, we will see that kung anong unod ni shareholders equity. 1 plus debt to equity ratio. Kadamo pa sang formula. So I have here, okay, here. So if you could see my screen, okay. So you have here, we have here an example of balance sheet, but this is not truly how the balance sheet looks like. Now, I just simplified the accounts, no, the types of accounts. I think this is not, this is not an example of accounts that is being used in accounting. No? Just to present it to you uh, in a simple manner, no, para mas maintindihan. So you have here the statement of financial position. You will see the total assets, the total liabilities, the total no, this is not the total share holders equity, no. So I have also here the copy of the formulas, no, para hindi kita magbalik-balik. Now you have here the assets, current assets, non-current assets. So you have here total assets. We have current assets of 3 million, non-current assets of 7 million. So we have a total assets of 10 million. So under the liabilities in shareholders equity, for our liabilities, we have current liabilities and non-current liabilities. That would be 2 million and 2.5 million respectively. So our total liabilities is 4.5 million. For our shareholders equity consists of our common stock, no, common stock of 1 million, or the ordinary shares, and the retained earnings of 4.5. So we have a total shareholders equity of 5.5 million. So our total liabilities and shareholders equity is 10 million, which equals, of course, our total assets. So that means our total assets consist of 4.5 financing from our creditors and 5.5 financing of our owners, no, plus the accumulated earnings. So muna ni siya ang na-earn na sang company, no, through its continued operation. So that will form part of our shareholders equity. So first, let's get the debt ratio. So debt ratio is total debt divided by the total equity or the total assets. So you have here the total liabilities. So divided by your total equity. That would be liabilities is shareholders equity or the total assets. So our debt ratio is 45%. That means we are owned by the creditors by 45%. So the company is owned by the creditors for 45%. That is their share in the corporation. So that's quite big na, no? So another one is, yes, the total debt divided by the total assets. As I've said, debt ratio simply is the ratio of the total liabilities to our total assets, no? So still 45%. That means we are owned by the creditors by 45%. So muna siya si debt ratio. Then we'll try. Actually, this equity multiplier, first time ko ni siya na-encounter. So we'll see. So hamalya ko no, equity multiplier is the total equity divided by shareholder, or total equity divided by the shareholders equity. Okay. So that would be, na follow lang kamo class kung diin ang ako niya, kung diin ko kakadto nga cell. So that would be your total equity divided by the shareholders equity. So that would be 1.81. Yes, 1.81. So balya, equity multiplier minus 1 divided by the equity multiplier. Okay. So equity multiplier less 1, we'll see kung we will get 45%. Just follow. Excuse me. I think equity multiplier is not that important, no? As long as you get kung ano ang meaning ni debt ratio. So amo na siya, that would be enough. So you don't need to memorize the equity multiplier, no? As long as you get the point that the debt ratio is the ratio kung sa diin na dira naton mabalaan kung pila ang share ni creditor sa aton nga company, no? Kung pila yan na finance sa aton, no? So data mabalaan if the company is stable or not. Okay? So balya is equity multiplier divided by last one divided by the equity multiplier. Okay. Oh, that's -1. Okay, equity multiplier. No, I don't. No. It's divide, gin minus ko. Okay, that's 45%, still the same. Now we just have proved that this formula is, yeah, it's effective. But I'm not, for me, no, I will not use that, no, and for purposes of examination, as long as I have the figure for my total liabilities and for my total assets. So why use the equity multiplier formula? Okay, so next is equity ratio. That would be, of course, pagkuha mo sang debt ratio mo, you will get the equity ratio. That means if your debt ratio is 45%, that means your equity ratio is 55%. So 45 plus 55, that would be 100%, which that represents our total assets. But for purposes of discussion, I will show you how to get the debt, yes, the equity ratio. 1 minus this. So you have 55%. Or simply your equity, no, sala. Okay. Equity divided by your total assets. 55% equity ratio or hambalya 1 minus equity multiplier. Really? No, I won't use that formula. Think I will not get the 55%. No, do not use this formula, the 1 minus equity multiplier. This is from the book that the source, sa source ko ni siya ginsunod. But I will not encourage you to use the equity multiplier formula because that will just complicate things, no? As long as you know how to get the equity ratio, the debt ratio, and you understand result, so that's the essence of learning this part, no, sa financing ratios. But I don't in my point of view, wala ko kasalig sa equity multiplier, okay? So debt to equity. So erase ko ni siya. Okay, hindi ko na nakag-erase. Debt to equity ratio, that would be your total debt and the shareholders equity. This is what I'm trying to show you. Debt to equity, that's the relationship of your debt to your equity alone. Okay? So you might be wondering, Miss, you nagambal ka nga equity is also equals to your total assets. So in this formula, equity here is the shareholders equity. No, it's quite misleading man ang name. But this is why I'm presenting you paano magkuha sang debt to equity ratio. Kay kung sa aton kung sa ngalan talang basihan, debt to equity, equity is equal to your asset, bali miss, equity is the same with assets. So if that's the case, uh, still the same with the debt ratio. But debt to equity ratio is different with the debt ratio. So to show you, it's total liabilities divided by your shareholders equity. So your debt to equity ratio is 82%. So that means your liabilities is 82% of your shareholders equity. Okay? Sa ngalan niya, debt to equity ratio. So, hindi taman pwede mabal nga debt to shareholders equity ratio. That would be too long. No, kalawig. Okay? So, muna sa. So, that's our financing ratios. The debt ratio, equity ratio, debt to equity ratio. Okay? So, tara naton mabal-ano to kung magkadto naman ta sa mga decision making process na, of course we are analyzing financial statements for decision making purposes. The trick here is we are doing this to see kung ano na ang status ni company, no? Base ba lang sige lang kita, if you own a corporation or if you are in a corporation, there's something wrong with the company nga sige na lang pangutang. Then pagka-ending, pag-analyze na, you see the balance sheet, you have your total assets, the total liabilities, the equity. Losing si company, damo-damo utang. Paglantaw mo, we are already owned by the company. We are already owned na pala by the creditors by almost 95%. So that's very alarming na. That means kaya na tayo baklo ni creditor. So hindi na majority. So amo na ang atong ginabantayan, no, if we are doing analysis, no, financial statement analysis, amo naton bantayan, no. That's to understand the standing or the current position of the company. So this is very critical. We must monitor this, no, ang liabilities ta pila na ang percentage nga bilin sa owners. So that's it. So that's the essence. Amo na siya ang aton nga purpose why we are studying this course or subject. So I'm gonna go back. Okay, so we're done with this. Next is the financial leverage and financing risk. So financial leverage is the ability of the business to maximize ordinary shareholders' equity through prudent use of debt. So there are people nga hadlok sa utang, no? But hindi naman na sila mapunggan, no? Pero sa akon, I don't like having utang. Kay sometimes hindi ko katulog. But different ya sa corporation. So sa corporation, it's not good nga wala siya liabilities. No? All all owners lang. So it's not balik awot. So kinahanglan taman mangutang. Um our goal, no, sa corporation is to increase the wealth of the shareholders. So in order to increase the wealth of the shareholders, or that would tantamount to increasing the value of the firm. So mutuhang ba ko kagina, we must have a high equity ratio, no? Hindi tayo hindi we must not have a high debt ratio. That's not good. Leverage lang. Daw man na siya ginaminya. So, you are incurring liabilities in order to increase the wealth of the shareholders. So, amo na siya yung financial leverage and financing risk. No? So, amo na siya meaning sa aton nga first statement. Financial leverage is the ability of the business to maximize ordinary shareholders' equity through prudent use of debt. So, nagapangutang kita, no, wisely in order to maximize our shareholders' equity. So the higher the debt ratio, the more financially leveraged the company. The higher the financing risk, and the higher the return on the shareholders' equity. But not too much. No? As I have said, not too much, not too high nga debt ratio. No? Kay that's very alarming. So, if taas mo debt ratio, yes, you are financially leveraged. Taas man ang risk, of course, no, as what I have said. But if you are using those liabilities that you are incurring wisely, then of course you can have a higher return, no, on your shareholders' equity. So if you have a higher return, but you are having a higher risk, since you are having a higher debt ratio, then a higher return means increasing the value of the firm, increasing your shareholders' equity. So, amo ni siya ang the risk-return trade-off comes into play. So, if the risk is high, the return is high. The higher the risk, the higher the return. So, if the risk is low, so the return is low. Of course, if you are taking higher risk, so if the result is positive, taas man imo return. But higher the risk, you also expect if it will not prosper, of course, you will lose a lot. No? So, amo na siya. Amo na siya ang hampang, no? Ang risk-return trade-off na nga ginahugutan naton per me, no? The higher the risk, the higher the return. So, amo na siya. So, that ends our first part. We're done with the financing activities, no? The financing side and the financial leverage. So we still have the investing and the operating. So I'll end my video here, and I will make another one for the next topic. Thank you, and have a nice day.